Howdy, Team 42. It's your skipper here to present our monthly macro scouting report for October 2021. As always, we got a ton of data to get through and some cool shirts to wear while we're getting through it. So let's just hop right in. Starting with slide 3, our table of contents. So we got the intro to the process on slides 4 through 20, portfolio construction summary on slides 21 through 23. We got our U.S. economic outlook on slides 24 through 69. We're actually going to talk about upside, downside risk to growth. We're going to talk about whether inflation is transitory, which we think it is in rate of change terms. We're also going to talk about why we think it's persistent in terms of the level, overall level of inflation as well. We'll follow that up by our China economic outlook. That's on slides 70 through 80. We'll talk about why Chinese growth is unlikely to rebound anytime soon. We'll transition that to our European economic outlook. That's on slide 81 through 89. We'll talk about the stagflation risk we see there accelerating rapidly, although Putin looks like he's trying to save the market here this morning. And then we'll wrap it up again with our portfolio construction guidance. And as always, for you data junkies out there, we'll throw in our grid asset market backtest data, not only for the main indices, but also for all the exposures represented in the portfolio construction. So just getting right into it here on slide 4, just kind of introducing our 42 macro grid framework. We use this to measure and map bottom-up macro regime cycles. So on the x-axis, or the y-axis, we got the 3-month delta of the OECD composite leading indicator. On the y-axis, we got the 3-month delta of headline CPI. So when growth's up and inflation's down, that's when you have Goldilocks. When growth's up and inflation's up, that's when you have reflation. When growth's down and inflation's up, that's what we call inflation. Some people call it stagflation. Doesn't make a difference. That's what it is. Growth down and inflation down, that's what we call deflation. So obviously our goal is to measure, map, and predict where the economy is and where the economy's been and where the economy's headed with respect to this regime segmentation process. On slide 5, the grids are global, so we do that process. We use very sophisticated econometric tools to project the grids, both for the U.S. economy up here, first row, and then all for all the major economies in the world, the OECD economies. And then what we added here for this presentation is the conditional probability, the median conditional probability of being in any one of these 4 regimes with respect to this entire sample. And as you can see, the red line, the red bars here, we're kind of getting into the thick of it, where the median conditional probability of inflation or stagflation, however you want to call it, is actually its highest. So it's no surprise to see the asset markets are really, 1, pricing in inflation, but 2, actually that's become obviously the front and center debate among investors in recent weeks. Slide 6, why does grid work? Well, we stand on the shoulders of Ray Dalio, Danny Kahneman, and Ben Mandelbrot. You let you read the quotes, but the reality is as smart as I may be or may not be, I'll never be smart enough to sort of outthink and outsmart asset markets by myself, which is why we lean on some of the historical findings of those real giants in our industry. On slide 7 here, looking at our global macro risk matrix, we use this to measure and map top-down market regime cycles. So it's one thing to know what the economy is doing in bottom-up macro regime space, but we also need to understand the weather, and the weather is the top-down market regime cycle. So what we're doing is we're knocking on the door of each of these 42 markets in the matrix and saying, hey, are you bullish, you bearish? If you're bullish or if you're bearish, you're probably signaling 1 or 2 or more of the 4 grid regimes, and we tally those up on slide 8. And at any given moment, the regime with the highest score, the highest number of confirming markets, which happens to be inflation at the current juncture, that's what we said to be the dominant market regime. One thing that's interesting about this chart, the overall conviction score right now is actually quite low. We're only in the 23rd percentile of the sample of the light blue line going all the way back to January 1998. That means one of 2 things. 1, investor positioning associated with this reflationary regime is not really quite baked, because it's probably going to be a transitory transitory kind of bout of cross-asset volatility. You get your 3 to 5 to 7, 8% correction versus your more meaningful 10, 12, 15, 20% correction. Or if this conviction score continues to rise, it probably means inflation is going to take you to a more serious bout of cross-asset volatility. So we're at an interesting crossroads here. That's something to call out using math to gauge that. On slide 9, looking at our market regime probabilities. So one thing that's been pretty consistent is that, hey, since basically July 1st, the system has been quite confused with respect to what regime to bet on. And I would argue investors themselves have been quite confused. You go back to like Q4 of 19 all the way to Q1 of this year. There's very clearly reflation, followed by very clear and obvious deflation, followed by very clear and obvious Goldilocks if you're paying attention, and then followed by very clear and obvious reflation, one of the most historic reflation trades, if not the most historic reflation trade ever, in terms of the breadth and magnitude that we saw across asset markets. Now we were in this jumbled mess with respect to the dispersion we're seeing among the four grid regimes and market regime probability space, and that obviously has contributed to a lot of consternation. And in the confluence of some of these sort of fiscal policy dynamics that we'll touch on later, that might actually become an issue for asset markets. But for now, it's really been something that's limited overall positioning in terms of net length and investor leverage. On slide 10, looking at the dominant market regime, there are no real call outs here, but as you can see, we've been playing dominant market regime ping pong for a while now, and it's actually starting to catch up to us in terms of actually, investors deciding to take down the overall risk. On slide 11, looking at our cross-asset correction risk indicator, obviously how to use this chart is pretty simple. When the purple line is in the green box, that it's indicative of we're probably at a market bottom, a local bottom in the markets, because the probability of the two risk-off regimes is actually quite high. Or if we're one of these setups, which is typically what you see ahead of a meaningful market decline, that means that there's a consensus complacency out there. Right now we're at 74%. That's not neither signaling consensus fear nor signaling complacency, but obviously a lot closer to signaling consensus fear than it is complacency. So that's something to call out. On slide 12, our market regime nowcasting process is really good at helping investors avoid drawdowns and getting back in. So we think we could potentially be on the precipice of one. We wrote about that in this morning's lead-off morning note. Again, I think the range of probable outcomes, both to the upside and to the downside, is quite wide still. So it doesn't necessarily mean you need to go run out and do something today on that. But at the margin, you should be raising your cash profile, your risk, decreasing your risk profile with respect to markets in light of some of these signals that we'll touch on in the deck. On slide 13, getting into some of the VAMS and probable ranges for the key asset classes. So the S&P 500 is still neutral. It's oversold here. Crude oil is still bullish. It's a raging bull market alongside most things in energy. Slide 14, one thing I've been talking about is the bearish trifecta. Whenever you see the U.S. dollar breakout alongside a breakout in high yield credit spreads and a breakdown in the VVIX-VIX ratio, that is a clean cut, get the heck out of asset risk asset signal. So now we have two of those things occurring. We had a bullish VAMS breakout in the dollar. As you can see, it's a probable range is intricately linked to that process. We're now seeing a little bit more upside. Same thing with the 10-year break even. So it's unusual to see the dollar break out to the same alongside the 10-year break even. But what it's telling you is that the short end of the curve is increasingly pricing in that the Fed might actually have to hurry up on its policy rate guidance with respect to some of these emergent inflation pressures, both in the U.S. economy and abroad. On slide 15, look at the Treasury yield. Continue to think that 1.416 is the most likely range as we progress throughout this Q4 period. High yield OAS, so in terms of the bearish trifecta, this is still neutral. Hasn't broken out yet. As you can see, we're still making lower highs relative to where we were in August. That is a good thing, but it's a good thing for now. Emphasis on for now. We'll see if that changes. If it changes, we're going to change. If it doesn't change, we're not going to change. On slide, as simple as that. On slide 16, so something I've been highlighting is that we've seen a bullish VAMS breakout in the high beta low beta ratio. That's pretty consistent with a a reflation trade, a pro risk setting. We've seen the small cap mega cap ratio kind of bottom. We've actually see the value to growth ratio here on slide 17 is on the verge of a bullish VAMS breakout as well. So those things you can make the case are signaling, hey, look, the market is very much trading like what we saw in October of 2020. You go back to September of 2020, we had a 9.5% drawdown, followed by I want to say an 8.5% drawdown in October. But the drawdown in October of 2020 was not like the drawdown in September. The drawdown in October was led to the downside by defensive sectors and style factors. Cyclicals outperformed, and what that was is the market actually used that weakness to start to rotate into pro-cyclical sectors and style factors into the reflation trade that we saw from November all the way through, let's call it June. That could potentially be what we see set up today. I still believe that is a very reasonable probability. I just do believe that in the context of the bearish VAMS breakdown and the VVIX-VIX ratio, which, oh, by the way, is really nice through its channel trend, and this bullish VAMS breakout in the dollar, it's telling you that the probability of the sanguine outcome is a little bit less than it was, let's say, a week ago. On slide 18, one reason that probability is more is because the vulnerability in the market is actually grinding higher. So the median IVOL, so in terms of reading this chart, really just focus on these four boxes. When you're down here, this is a no-no. When you're up here, there's a wall of worry. That's a good thing. When you're down here, people are crowding the charts. That's a doubly good thing in terms of buying stuff. And then here is just kind of a no man's land, just a bottoming process. BP will put it there. But the reality is all summer we've seen the median IVOL premium after these OPEX-driven corrections climb upwards towards 40 to 50%. That was kind of an all systems go, on buy the dip. Well, throughout this correction, really since it started in earnest in September, is we refuse to see these dots get up to 40 to 50% on a median basis. And what that's telling you is that investors think this correction is likely to not be sort of material or sustained, i.e. they think it's going to kind of be like all the rest of the corrections we've seen over the last trailing year or so, which is like, okay, 5% is at most we're going to get. That's effectively what they're betting on. Well, if it's not 5%, and oh, by the way, we have this debt ceiling catalyst that might make it not be more than 5%, what it's likely to do is catalyze investors to really start the rush for protection, really start to push these dots higher, and that rush for protection can reflexively feed on itself with respect to dealer positioning. People go rush to buy near-term puts. Guess who has to go rush to short near-term underlying? It's the dealer network. And so that's how you could get a reflexive down move in the market, in and around this debt ceiling catalyst. That's a lot more painful than investors are positioned for. Increasingly, because what we've seen is in our dispersion analysis is that it's gotten really pro-cyclical, and that can mean one of two things. Investors are using this like they're using October 2020 weakness to get out of all this sort of bond yield correlating, defensive sectors and style factors, and get themselves into things like high leverage, high beta, financials, energy, value, all those pro-cyclical sectors and style factors. Or a big firm like Citadel, Point72, all the big multi-manager pod shops are saying, hey, we're just taking down our gross. We're selling our winners, selling the longs that really helped us outperform throughout the summertime when we transitioned to Goldilocks from inflation. And then now we're covering shorts. You take that, you sell your longs, you cover shorts. That's a reduction in gross exposure, and that's a reasonable sort of measure to take if you believe the range of probable outcomes is as wide as it's been in a really long period of time, which means it's really hard to bet on one macro outcome relative to another, and that means it's investors are probably just using that as an opportunity to say, hey, let me take some chips off the table because I'm actually unsure about what the forward path for asset markets is likely to be. On slide 20, skipping ahead. It's increasingly the case that the scenario 2 might be more probabilistic, more real than the more sanguine scenario. You look at the month-on-month delta of S&P 500 futures and options in terms of speculative net length. That's up 120K, leaving us with speculative net length, a net long position of basically 81,000 contracts. So which means in 1 month's time, we swung from a net short position of minus 39,000 contracts to a net long position of plus 81,000 contracts. So I don't believe that's people buying the dip. I believe that's people covering shorts, going back to what we just discussed on slide 18 in our dispersion analysis. So what I'm really trying to say is, from a risk management perspective, the market is as vulnerable as it's been at any point in time in 2021. It's very vulnerable from the perspective of investors' unwillingness to pay for near-term protection. It's also very vulnerable from the perspective of investors now having covered a lot of shorts. Maybe they're getting long those shorts, but maybe there's certainly what we can observe is that they've probably covered a lot of those shorts as well. So particularly on the pro-cyclical sectors and style factor side of the equation. So not saying vulnerability equals a real connection, but certainly wanted to call that out and flag that, because you got to really pay attention to a lot of these data points on a rigorous daily basis to sort of spot those vulnerabilities. Skipping ahead to slide 23, looking at our posterior portfolio construction. So we wanted to take down, in the context of those vulnerabilities, we're not quite ready to say, hey, it's about to be risk off and, we got to head for the hills and take this cash balance to, 40 to 50%. I got laughed at last time I did that. It's probably a good call in retrospect, but that's neither here nor there. What is here now is, okay, hey, look, we want to be selling our exposure to the S&P 500 and the Barclays Ag, because in terms of our views on bond yields having upside to 160 on the 10-year, 230 on the 30-year, I think that is likely to hurt in terms of duration risk here, and also duration risk here with respect to the mega cap fame type names. So we definitely want to be selling that and increasing our exposure to an inflationary outcome. We'll talk about this from a fundamental perspective, why we think the risk is rising. Going back to slide 5, that stagflation is having a real serious debate here in Q4 with respect to the economic outcome. So with adding, replacing SPY and Ag, booking those, and adding Brent crude oil, giving ourselves a little bit more energy exposure with Brent, B&O, and UGA, the gasoline fund. Slide 24, getting into our U.S. economic outlook. Welcome to Grid Zero. Grid Zero just means you're hovering near the origin on both the y-axis and the x-axis. And the reason you're hovering near the origin, or as a function of hovering near the origin in delta terms, you're seeing the conditional probabilities of a lot of these, of all four of the grid regimes actually kind of huddle near each other. And it's exactly what asset markets have been pricing in since July, which is a very limited amount of dispersion with respect to the actual underlying economy in delta terms. There's really not much projected. Now, deflation, this regime is the highest probability regime, and so it's reflected at the top of this chart as the modal outcome. But as you can see, its probability is a lot closer to the other regimes than we've seen in recent months, where it's very obvious reflation, very obvious deflation, things of that nature. So we have to be aware of that, and that's exactly why we think investors might be taking down their gross exposure in the context of all the consternation we've seen in asset markets all summer. Looking at U.S. growth, our secular view. So one thing we added to this chart is just looking at the Bloomberg consensus forecast, just to sort of see if we're above or below consensus with respect to not only the rate of change and slope, but also magnitude of what we have the economy headed over the next 12 months. No real meaningful delta there, but as you can see, we're kind of getting in this point where growth's like flat to down, and eventually we'll get into a more steep deceleration as you get into the climb into 2022. On slide 26, looking at our nowcast model for growth, nothing major to call out, but maybe this auto sales figure down here, down 25.5%, as evidence of more supply chain inefficiencies. On slide 27, the unwind of peak delta may serve to mitigate supply chain disruptions stemming from the U.S. labor market. So this right here is the prime working age labor force participation rate. If we get past peak delta, that's going to go up, and it's going to mitigate some of these some of the supply chain disruptions stemming from record job openings relative to not enough supply of labor at the current juncture. On slide 28, that said, the cost of doing business is likely to continue to creep higher over the medium term. This is the all-time high in the JOLTS quit rate. This is the employment cost index. That red line is definitely going to chase the blue line higher over the intermediate term. On slide 29, looking at global manufacturing PMIs, they need to demonstrate some strength to stave off the development of negative rate of change trends in Q4. And I do believe we're likely to see some strength. We saw that in the ISMs. And so, maybe Q4 with these dots stop where they are and go back this way, but eventually we're all headed down this way because, again, that's just we're coming off record fiscal impulse, record monetary easing, record easy base effects. All those things are transitory in terms of the forward outlook for growth on a medium term basis, i.e. over the next 12 months. Same thing with services PMIs. They should bounce. We saw the September bounce in the ISM PMIs. But how long can they bounce in the context of everything I just said with respect to those one-time in nature impulses? Unlikely to sustain themselves beyond Q4, but Q4 is setting up to be a decent quarter in that regard. On slide 30, supply chain disruptions may be past peak in impulse terms, and this is what I mean by past peak. We're no longer making new highs with respect to ISM manufacturing and prices indices. They're past peak in impulse terms, but past peak on slide 31 here, past peak does not mean there's no supply chain disruptions. Like this is the 2-year break evens. It hasn't gone down. Baltic Dry Index is still making highs. And you look at the ISM supplier delivery times, and this is the percentage of respondents that said supplier deliveries are slower for both manufacturing blue line and services for the red line. So we're not as high as we were at the height of COVID when the economy was shut down, but we're not much further from that anyway. Like this is, you draw a sure line on this chart all the way back, and like we're still in no man's land in terms of supply chain disruptions and supply-demand imbalances that may be feeding through to higher prices here in Q4 in terms of potential upside surprise to our projections and other projections across Wall Street. On slide 32, we're looking at supply chain disruptions that are starting to impact earnings. So this is earnings for the Russell 1000 Defensive Index, and we're ever so slightly getting towards negative. You look at slide 33, Russell 1000 Dynamic, that's the cyclicals component. We actually are negative on a 4-week rate of change basis with respect to earnings. So, clearly this gave way to this. And the real question investors want to know, is it about to give way to this? I think the balance of risk is suggestive that this can continue. But certainly the new risks that are emerging suggest this is increasingly probable. It's going from possible to probable, and that's what investors are really trying to price in at the current juncture. On slide 34, thus far, the impact of supply chain disruptions has been mostly felt by inflation, but slowing growth is an emergent risk. I highlighted auto sales are down 25.5% year over year, contracting at a 57% annualized pace in September. That's pretty meaningful. 57% annualized. I mean, is this thing going back to the lows of COVID? Probably not, but it's telling you that, hey, look, if we can't make manufacturing enough stuff and we can't get people to show up to work, you're not going to get the same output in the economy, and that's going to be inflationary for the goods and services that are left to be purchased. On slide 35, we're sort of seeing similar dynamics in new home sales, down year over year for 3 consecutive months, down 24% year over year in September. That's a pretty big slowdown. On slide 36, you've seen this chart from me before, but if inflation continues to surprise to the upside from here, risk assets are likely doomed. And what you're seeing in this chart here is these dotted lines. You look at when the real S&P 500 earnings yield is denoted by this blue line. Every time it's gone negative, you've seen it ahead of a decent sized correction in assets. Was this 5, 6, 7%, 7, 8%? Boom, 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 boom. We don't want boom. We're trying to avoid boom here. So, but it's our goal not to hope that boom doesn't come. It's our goal to bean count all the data and the market signals in the interim to say, hey, when is the probability rising that we're going to see something like this versus something like this? And I think the reality is the balance of risks are starting to move in a direction that a big boom could potentially be coming. I don't think it's here yet. Let me be very clear about that. But it's certainly, if we do see some more stagflationary upside surprises in inflation, both domestically and abroad this quarter, in the context of a Chinese slowdown, in the context of a U.S. debt ceiling impasse, I think the risks are certainly emerging with respect to the vulnerabilities that I highlighted earlier in our crowding and dispersion analysis. If those things are what they are from a vulnerability perspective, it won't take much to get a big boom. So the asset markets are at a really critical juncture here. We need to survive this, both technically, quantitatively, and the data needs to support a survival of those things. On slide 37, the patient cannot survive with increasing quantities of medicine. This right here is the blue line, is the Fed's balance sheet. Every time we've seen a flattening out of the Fed's balance sheet, or decline in the Fed's balance sheet, we've seen spikes in the financial conditions index. It's inversely correlated to stocks and credit. Means financial conditions are tightening. That's not good. The real question is, okay, tapering is going to take us from this exponential pace to a more logarithmic pace of growth. And the reality is okay, when does the Treasury come back and really kind of weigh on that logarithmic pace of growth and catalyze a real negative inflection? We'll talk about that in a couple slides. But on slide 38 here, will this consensus wall of worry surrounding inflation, because obviously it's the number 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 story. You pull up your Bloomberg, you pull up your CNBC, you pull up FinTwit. Stagflation is like the number 1 thing that people are concerned about. But the reality is when people get concerned, they tend to overpay for protection. So obviously near-term implied volatility premiums are actually quite depressed, which means the next couple of weeks are actually quite vulnerable. However, skew on a 1, 2, 3, 4 month basis is actually quite steep. So is the term structure volatility, and both those things are suggestive that you could see a Santa Claus rally, just like what we saw in Q4 of 17 and in Q1 of 18, Q4 of 19 and in Q1 of 20, in the context of that skew and that term structure burning off. That is still a legitimate risk. I'm just, so you now have this sort of dynamic in between now and then about the debt ceiling occurring in the context the market is actually quite naked and quite vulnerable with respect to shorts and its near-term protection. So I'm calling it like I see it. I don't think it's prudent to sort of just guess on which outcome. I think you might actually have both outcomes. You could see a wash out of the markets in October and a meaningfully sharp recovery after that. But we obviously don't want to be walking into that meaningfully sharp decline if we have anything to say about that. So this is why we bean count the data. And if we see the bearish trifecta, we're going to raise a lot of cash in the portfolio construction. On slide 39, going back to the positive outcome, you basically have a 2/3 chance of a positive resolution to all the nonsense going on down in DC. As I tend to say, you generally want to ignore how the sausage is made, because the sausage usually gets made down in DC. It's always going to be messy. Bull cases, the debt ceiling gets lifted with some GOP support. President Biden's agenda is haircut by, let's call it, a 1.5 trillion. You get $2 trillion out the door on that. $550 billion infrastructure bill passed and it's signed onto law by that October. The base case is if debt ceiling gets lifted in one of 2 ways with no GOP support. President Biden's agenda is haircut by $2 trillion or more, and the physical infrastructure gets signed into law, but it takes a little bit longer in terms of some of the processes they have to use to get the debt ceiling hiked by themselves. And then the bear case look, the market is telling you it's increasingly probable, maybe not increasingly probable, but the market is telling you that it's increasingly vulnerable to the bear case. The bear case, if the median implied vol premium was 50, 60, 70%, I wouldn't care too much about the bear case, because you would suggest that there'd be limited downside in asset markets from a risk asset perspective. But with the 17% median vol premium and people having very clearly covered shorts, both through the lens of the CFTC data and also the month-on-month Sharpe ratio data we're tracking, the market is vulnerable. And the bear case is one that could catalyze a real meaningful risk-off move, like we saw in 2011 when S&P downgraded the U.S. debt. They could come out and do it again, and that can obviously cause some carnage in the context of the vulnerabilities that we're spotting. Pretend like I know what's going to happen. I'm not going to pretend, rather, but I do know that you have basically a 2/3 probability something positive happen. So let's anchor on the higher of the outcomes, the modal outcome. This we know. Investors have near record amounts of cash on hand. It's very unusual to see high cash with easy financial conditions. It's telling you people don't want to buy bonds. On slide 41, this we know as well. Net liquidity supply is unlikely to inflect lower for at least a few months. As I mentioned, we're going to go from this exponential curve to this more logarithmic extent. And really, you really want to be out of risk assets when that logarithmic ascent starts to go negative. To me, that's something that's more of a Q1, Q2 event of next year, in my opinion, or at least until further notice. On slide 42, this we also know overnight repo market activity. That's this line here, 1.4 trillion and counting, suggests there's ample capacity from a liquidity perspective for asset markets to offset the return of the bully here in Q4. Right, when the bully comes back, the bully is going to start issuing bills and issuing debt. The bully is the U.S. Treasury Department on the other side of the debt ceiling, and more importantly, when the budget resolution is finally authorized into law, the bully is going to come back and start tapping public debt markets with a vengeance. Obviously, we've seen the Treasury cash balance go, TGA account go from north of $1.5 trillion to $2 trillion or $200 billion of late. Could get down to close to zero as we did in 2011. This thing got down to $10 billion in 2011, so maybe it's another minus 200 to go here over the next couple of weeks. But the reality is this bull line is going to bottom and start to head back up later this year or early part of next year when the Treasury does return to the market. But for now, we do see ample scope for that borrowing bench to be absorbed peacefully and gracefully. That would be an issue if there was no scope for it to be absorbed peacefully and gracefully. And you can make the case going back to slide 41, going back to this record amount of cash on hand. Now that yields are much higher than they were, let's say in mid or early to mid August, people might actually start to capitalize the U.S. government and want to capitalize the U.S. government and not necessarily need to sell stocks and other risk assets to do so. On slide 43, getting into our inflation view here. No real changes to our inflation view. Like we're definitely still in the transitory camp in rate of change terms, but in levels terms, you see where it's going to start to kind of bottom here in late Q22, early 23. That's a much higher level. That's a much higher level of inflation in terms of the bottoming. It's not bottoming down here like it used to. It's not bottoming down here. Bottoming down here is a very different discussion. When do asset markets figure that out and have to price that in terms of a more accelerated timeline with respect to policy rate tightening? I think we have plenty of scope and plenty of time to demarcate between now and that event occurring. If it occurs here in Q4, it's probably because we're seeing a real true energy crisis like what we saw in 2008 develop both in the U.S. and abroad. That's something obviously we're going to have to bean count in real time. We can't just guess. We don't live in the realm of guessing. On slide 44, we live in the realm of bean counting. This is our agent-based nowcast model for U.S. inflation. And with respect to bean counting, you look at commodities and industrials and things like that and food. The year-over-year rate of change, inclusive of all the price appreciation we've seen of late, is actually still slowing. That's a good thing. ISM prices index is going back up. However, it tells you it's not all just about commodity prices. It's the cost of storage, it's the cost of shipping, it's the cost of labor, telling you that inflation may actually start to bite a little bit more at the margins in Q4 than it has in the last couple of months. Slide 45. This we know too. Demographics are still very much disinflationary across the developed world. X-axis is the 5-year forward old age dependency ratio, what percentage of your economy of your population is older than the age of 65, and the working age population 5-year forward CAGR, compound average growth rate. So if you're down here, especially if you're Japan, you've disinflationary demographics on a 5-year look forward basis. U.S. is getting pretty old. We're not quite at the point where we're have contraction in our labor force, but again, all those things are moving towards being disinflationary. On slide 46 here. The secular drivers of disinflation, demographics, technology, globalization are still largely intact. We're showing the labor force participation rate, velocity of money, imports of goods and services, and also just sort of we're showing here NASDAQ 100 market cap relative to Russell 3000 market cap. That's the broadest measure of U.S. stocks. And as you can see, it's been straight up and to the right. That obviously, COVID was an accelerant on that. And so if you believe that was a disinflationary impulse over this kind of 20-year period, you have to also agree that, hey, this is also disinflationary. You can't just say, it's COVID, so now everything's inflation. No, we've had some things occur in the economy that may actually make it more disinflationary. You think about decentralized finance. That, to me, is the most disinflationary thing known to mankind. That's a longer-term tail on that. But, you'd be talking about a very deflated, disinflationary U.S. economy and global economy, 5, 6, 7 years from now. But again, it's October 2021. So let's talk about the risk of Q4 21 and Q1 of 22. We'll refresh when we get there. On slide 47, corporate America continues to be dominated by monopsonies. That's monopsonies were just as a proxy. S&P 100 largest companies in the S&P 500 that market cap divided by the broader index up and to the right as well. So it's telling you that big companies have increasing power over not only the economy and economic output, but also over bargaining power with respect to wages. And then you have a broad-based preference for capital expenditures over labor. That's employee compensation relative to the consumption of fixed capital. Just lower highs and lower lows for decades. We're all being replaced by robots at the margin. It was a 120 slide deck with one guy. This used to be 4 guys, and 10 years ago it was 5 guys, 6 guys, 7 guys. It's usually guys. Unfortunately, we still need to get a lot more women in our industry, but that's neither here nor there for this presentation. On slide 48, cyclically speaking, we are observing evidence of past peak domestic price pressures. So when you look at these charts, look at the third panel. That's the annualized month-on-month percentage change. We've come down a decent amount on headline CPI. Core CPI momentum has been cut by 90%. Down to 1.2%. Again, these things may bounce in Q4. That's what I'm trying to highlight. Hey, if we start to reopen again after Delta, you may get a little bit more pressure on inflation. But the real key takeaway is, does that sequential pressure really catalyze an inflection higher in the year-over-year rate of change? And that's to be determined. That certainly is to be determined. You look at the key drivers of inflation at the moment. They sort of appear to be driven by temporary supply-demand imbalances rather than something more permanent. You got used cars, now it's contracting it. We were talking about used cars up here, but now it's down 17%. I haven't heard a thing about used cars in the last couple of months. Airfares, but now they're contracting at that 70% annualized pace. Haven't heard a thing about airfares in the last couple of months. And hotels. Now they're contracting at 33% annualized pace over the last couple of months. Don't get whipped around by media headlines. This is the whole point of doing the math, doing data. You want to be able to front run the change in the narrative as opposed to reacting to the narrative. On slide 53, less volatile measures of inflation are also signs of slowing down. So this is core PC right here, the Fed's preferred inflation metric, and it's gone from 8% on an annualized month-over-month basis to just a little bit over 4%. So that's good. That's positive and cut in half. Now again, do we just stay at 4%? I would argue that's probably not the best outcome for markets. You like to see this really start to maybe bleed lower at some point. Sorry, I don't want to do that, but at any point. Yeah. Keep it moving here on slide 54. If we're proven right on our call for inflation to trend lower throughout the second half of this year, and really throughout the kind of really throughout 2022, the real disinflation we're going to really start to see in Q1 and Q2 of next year. We got to get through this kind of period where inflation's flattened down, which is why the macro regime probabilities are as wide as they are, and the market regime probabilities are a function of those probabilities, kind of being kind of huddled near to each other. But the reality is, this chart just shows the blue line, the red line. That's housing prices relative to owner's equivalent rent. Whenever you see a big spread, kind of in the two, i.e., housing prices are way higher than housing prices appreciation is much higher than owner's equivalent rent. You've typically seen this massive recovery in owner's equivalent rent over the next ensuing years. Takes 2, 3, 4 years for that to fully reprice in and get baked into the owner's equivalent rent equation. So that effectively means that you should be expecting for shelter CPI to continue its ascent higher. We've been talking about this since last November and saying, hey, shelter CPI is going to bottom in Q1. It's going to go up for several years. Don't overreact to it. And we're kind of halfway into the, don't overreact to it phase. We got another halfway to go in terms of that. On slide 56, median CPI. So that's everything, the shelter CPI, all that stuff is kind of telling you, hey, even though we're going to have disinflation in tradable goods and the year-over-year rate of change of commodity price inflation is likely to slow, even though we're still grinding higher on a sequential basis, you have things occurring underneath the hood that say, hey, once that disinflation is done, we're going to have inflation at a much higher level in terms of the terminal destination for the disinflation at a much higher level than we've seen in recent years. And part of the reason you're starting to see more broadening of the inflation pressures, this is median CPI, you're actually seeing that accelerate to 4% here, right? That's a big difference, that your median CPI, that's the balance of things in the basket, not just, airfares and used cars and things of that nature going up and down a lot. It's the stuff closer to the middle that suggested that there is a little bit more inflation pressure in the economy. On slide 57, trim mean PCE inflation remains structurally depressed, as you can obviously see by this chart, but the new highs for the 6-month annualized time series, that's telling you that this time series needs to be watched. It's sending the same message as the median CPI. We're just kind of breaking out of its post-crisis zone, kind of breaking out of its post-crisis range. Same thing with this Dallas Fed trim mean 6-month median PC inflation. Like as I mentioned at the outset of the presentation, the next few months is when the macro regime probability, with a conditional probability of most economies in the world to experience stagflation, is the highest over the next few months. So it's no surprise to me, again, that investors are super concerned about stagflation. It's also no surprise to me that stagflation, or inflation as we call it, is the dominant market regime at the current juncture. This too shall pass, but how will it pass is the key question. Is it a head fake in terms of signaling risk off, or kind of limiting the downside of the S&P, for example, to 5%, or is it more like this real nasty, scary stagflation that we saw in 2008 and really in 2000, early part of 2001? We'll see. Who knows? I think that's what we work so hard to figure out. On slide 58 here, kind of talking about like the why we believe inflation will be persistent in levels terms. Looking at the politics, the drivers of populism here in the U.S. in particular suggest we're an emerging market. Look at where our dot is. This is the Gini coefficient, income inequality. This is unemployment. We don't know what that is, and the U.S. wants to be hanging out with its buddies in Europe, like Germany, France, Netherlands, Denmark. It's not. We're hanging out with our Russian and Chinese pals. The guys who keep hacking us. We have political risk, and the reason we have political risk is on slide 59. I say this all the time in pro-to-pro meetings. This is the most important chart in macro. It proves why this sort of populism has bipartisan support, and it doesn't look like it has bipartisan support now. But we certainly had bipartisan support for blowing a hole in the budget deficit in 2017. We had bipartisan support for blowing a hole in the budget deficit in 2020. And it wasn't as bipartisan in the first part of this year, but it certainly wasn't as nonpartisan as we've seen it in recent cycles. So, and this chart showing employee compensation as a percent of GVA. That's the broadest measure of income. And corporate profits as a percent of GDP, kind of making new highs, and corporate profits as a percent of GDP, heading back to the lows for that. And the reason, this line peaked here in 2000, you had China join the WTO in 2001. You had the repeal of Glass-Steagall in the late 90s, the explosion of private equity and all the industry consolidation associated with that, and M&A and things of that nature. And then you obviously had the advent of the digital economy and all the disinflation and really lack of need for human beings doing stuff has really taken this blue line to some cyclical lows. I would argue that's why a former reality TV star became president, because he figured this out, if only because Steve Bannon helped him figure it out via way of the great work of my former colleague Neil Howe. On slide 60, balance of payments, who will be called upon to finance bipartisan populism in the U.S.? So obviously, the x-axis shows the current account balance, the y-axis shows the sovereign fiscal balance, and we're this is where our dot is. And again, our dot is a function of the panic associated with the zeitgeist that this chart is telling you exists. We got Black Lives Matter last summer. We got White Lives Matter in the Capitol building in January, and everybody's lives matter when they're poor and broke and angry, right? That's the whole point of this. And so, who's going to pay for all this debt? That's obviously a big debate in D.C. now. But the reality is this zeitgeist that's perpetuating all that debt is not going anywhere. If anything, it's gotten worse in COVID. On slide 61, so foreign central banks basically said, no, we're not going to pay for it since 2014. And part of the reason they're not paying for it is they levered up in dollar terms. And so they're perpetually short dollars, which has catalyzed a pretty meaningful dollar short squeeze since then. And so that it's made it harder for them to do this dollar recycling dance that they've gotten so used to, particularly in the pre-crisis era. On slide 62, that implies the Fed is going to be called upon to finance these budget deficits throughout the remainder of this fourth turning. This is the blue line is the Fed's balance sheet as a percent of U.S. public debt. This line is a financial conditions index, but inverted, so you can kind of match it up. You can see, whenever the Fed says, okay, we're not going to be in the business of capitalizing, assets, even this tiny little tick down here was a big problem for financial markets. You're supposed to fix the repo market, man, but then you stop fixing the repo market and the markets blew up. No, I'm joking. What I really mean is that, look, the Fed's got to do it. And if the Fed doesn't do it, then we're going to have problems. And that's kind of what we learned on slide 63 here. In the June FOMC, we basically said, hey, the terminal Fed funds rate, the dark blue line in this chart, basically said, let me vomit. They're going to raise the dot plot, and it's not an MMT central bank anymore. And that's that was a big deal for asset markets in terms of unwinding crowded reflation trades, which is obviously something we called out on Real Vision at the beginning of June. I would say that to say this, we've seen, rising federal fund, the terminal Fed funds rate since the September FOMC has actually gone up. And so it's telling you that, hey, this forward guidance that we're getting out of the Fed with respect to its policy rate being deeply negative in real terms all the way through its projection period, is telling you that this is a more reflationary Fed than investors were led to believe in this sort of kind of 3 month period here. So that's new. You got a structurally dovish Fed, means you have a longer economic expansion on slide 64 here, and longer economic expansion tells you you're going to have a steeper rate hike cycle. And then, this is euro dollar spreads, particularly the black line, just puked after the June FOMC. And then now they're starting to grind higher, and they're obviously higher post the September FOMC, irrespective of all the market volatility we're seeing in the S&P 500 and other risk assets as well. So the market is, it's telling you, the rates market is still saying, hey, look, this sanguine outcome that does favorable the outperformance of pro-cyclical sectors and style factors is still a legitimate possibility. You could still get this sort of, skew compression, term structure compression, risk on rally in Q4 on the other side of this debt summit debate. All I'm trying to call out with respect to our crowding and dispersion analyses and our CFTC analysis earlier was that, hey, the market is actually quite vulnerable to have a problem in between now and then. So we want to call that out. On slide 65, can the Fed set it and forget it with respect to tapering, or will they have to giddy up in the coming months? And really, to me, it's just a function of how quickly does the labor market supply come back online, or if it comes back online very slowly, how quickly will wages rise and really start to sort of change in consumer and business behavior with respect to growth, with respect to purchasing power. We've already seen that going through a lot of consumer confidence indices. With respect to consumer intentions to purchase durable goods, houses, things of that nature. Those are obviously, well off their highs, and that's something that it's telling you inflation's an issue. So, how will this get resolved? Can the Fed kind of tightrope this tapering process, or will they have to speed it up? On slide 66, if you don't get substantial further progress on the vaccine and treatment fronts, you still have 8 million people out of work and due to the pandemic. You got basically just shy of 6 million people who have retired, left the labor force altogether. You got an extra 3 million people or thereabouts unemployed. That's a meaningful delta in terms of the low level of aggregate demand, particularly as we go further and further into time. The personal savings rate kind of ticks lower. I think we're around 9.4 now. We peaked at, or we were at 8.6% right before COVID. So it's telling you we're running out of savings. If we're running out of savings, you're not going to see demand grow at all unless these people get their jobs back. So that's something to call out. On slide 67, we are already observing evidence of hysteresis starting to set in within the U.S. labor market. And what I mean by this is, this is the white unemployment here at the top panel, this Hispanic or Latino unemployment in the median panel, and then unemployment for blacks and African Americans, or whatever you want to call us these days. We're actually starting to tick up. You're starting to see a flattening of the improvement in the Hispanic employment rate. Obviously, this tends to be the least cyclical, the Caucasian unemployment rate. So, if this hysteresis really starts to set in, it's telling you we're going to have a structurally dovish Fed, because maximum and inclusive. Let's pretend like you can read that. Maximum and inclusive tells you that these lines need to get back to where they were pre-pandemic before the Fed is really going to be taking inflation seriously from a policy rate perspective. They might speed up tapering, but it doesn't necessarily mean that they're going to do anything on the policy rate because again, they want to let the economy run hot to effectively address racism with monetary policy. I don't think they're going to fix racism with monetary policy, but they've certainly said they're going to try. And again, the most recent information we've gotten with respect to the September FOMC catalyst suggests that they're going to maintain that posture even as we progress into the next year. On slide 68, so in all that, I say this to say that, like, how much higher can nominal rates go if we're talking about a Fed that's going to be super easy, the labor market that's very structurally impaired with respect to huge pockets of unemployment, huge drawdowns in labor force participation. Again, it may catalyze wage pressure in the short to medium term, but again, if that wage pressure is not sustainable in the context of an economy that is structurally lower demand due to some of those factors, that's something that we want to call out. So I'm kind of sticking with my call that just looking at Fibonacci retracements, and again, I tend not to rely too much on technicals, but I do think they matter in some of these hotbed moments. You got to basically a 1.4 to 1.6 range on the 10-year. We're talking about a 2 to 230 range on the 30-year. I just don't see, in the context of not having the positive shock to growth and the positive shock to inflation that we saw in the first half of this year, stemming from reopening, vaccination, record fiscal stimulus, the easiest base effects in U.S. economic and global economic history. You don't have those things. So why in the heck expect interest rates to be here and interest rates to be here, go back to here really quickly? You just don't have those things. Now, again, you might have the wage dynamic that's new, but again, I just don't know if that wage dynamic is sustainable in the context of what we just discussed. Looking at, so skipping ahead to slide 70 here. China grid outlook. Nothing new on China. Been saying the same exact thing on China since March of this year. You can go fact check me on that. Hey, look, China's going to slow. It's going to probably deepen. Its slowdown is going to be deepest in Q4 of this year. No changes there. Obviously, we've gotten a lot of headline risk since then. But it's really just confirmed a lot of everything we thought on China with respect to kind of this period here. As you can see here is our Chinese growth projections with respect to the OECD Composite Leading Index data, and then we have Bloomberg consensus expectations. We're not too divergent from Bloomberg and Delta terms. They're seeing the slowdown kind of trough in this range here. So that's something we want to call out in terms of, maybe the market expectations on China's growth slowdown has really reset itself, after, let's call it 6 weeks or 2 months of Evergrande related headline risk. On slide 72, our China nowcast model, meaning just blood red in a lot of places where it matters with respect to the credit cycle. As long as the credit cycle continues to be blood red, you're going to have a lot more blood. If credit cycle is blood red like it is here, it's going to lead to blood red in the real economy. Blood red here leads to blood red in the real economy. So you should expect that over the intermediate term. On slide 73, looking at leverage, is one of the 4 pillars that we look at. We talk about demographics, we talk about politics, we talk about balance of payments, and we talk about leverage. It's one of the 4 main pillars of structural economic risk that we really follow here at 42 Macro. Leverage, we look at that through the lens of the private non-financial sector credit to GDP ratio. Look at that on 3-year Z-score just to get all these economies on the same chart. Looking at the change in how much leverage the economy, the private sector of the economy has taken on or shed, and in the case of the Netherlands. Look at the private non-financial sector debt service ratio as well. When you're high on this chart, as denoted by the red, it's telling you if tightening, and just telling you of too much credit. Probably have some level of adverse selection, particularly when you get past a 2 sigma. So China's up here in this bright box. You typically see economies up here ahead of recessions. Right, this is where you bottom. You got credit. You've delevered. You've eased. And you can start to grow again and lever up again. Well, China's here now. And China understands that. I think Xi understands that. Beijing is well aware of that. And this is why they haven't panicked with respect to the China credit impulse. This China credit impulse is at a cyclical low, and they're not panicking like they have in previous cycles. That's on slide 75. You look at liquidity dynamics in the mainland, it suggests that it's unlikely the credit impulse there is, again, the big leading indicator for Chinese real growth, is unlikely to inflect higher, meaningfully higher anytime soon. And the reason I say that is the blue line here is 3-month Shibor. And again, I've talked about this ad nauseum, but the reason I focus on 3-month Shibor is because it's a perfect encapsulation of all the different tools that the PBOC can use to perpetuate credit innovation in the Chinese economy. They can lower the RRR, they can lower policy rates, although those things are kind of a tool of the past, and then they can obviously speed up or decay open market operations. They can speed up or decay medium-term financing. But the reality is it all sort of gets caught up in here because 80+%, 4/5 of private non-financial sector credit on the mainland economy is on bank balance sheet. So what happens in Shibor, what happens to interbank lending rates really, 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 really matters, which is why you've seen the credit cycle bottom, 2 to 300 basis point declines in 3-month Shibor have historically coincided with, meaningful recoveries in the Chinese credit cycle. Right here, boom, that was one of the biggest ones ever, saving us out of 08-09. Well, guess what's happening here to 3-month Shibor? The damn thing is going up now. Like they're in the middle of one of the steepest decelerations we've seen in Chinese economic activity in a really long time, if not ever. And they're allowing monetary policy to be neutral to tight. That's telling you their commitment to this sort of common prosperity initiative is something not to be messed with. They probably have a better word to use, not to be effed with, but I think people need to be aware of that. I think investors, that's definitely a big deal relative to previous cycles, and it does throw a wrench in the potentiality for a reflation trade on the other side of the sort of negativity we're seeing stemming from DC from a headline perspective, although I would argue a U.S. debt default is not a headline issue. That is a real issue with respect to the plumbing and financial markets. So expect some fireworks if we get down to the wire on brinksmanship. On slide 76, the transition to a secular weak dollar, higher nominal GDP environment will not be nearly as linear as the path investors convince themselves. Right? Like, this was like dollar went straight down, basically from June, July of last year to January this year. And you saw, the outperformance of defensive sectors and style factors just get eviscerated. So this is the blue line goes down. That means cyclicals are outperforming defensives. Defensives are underperforming. You've seen like defensives really start to recover as the dollar's gone higher, but you've seen this. You see this last little tick here. Cyclicals are now starting to win again, even though the dollar is going up. So that's not sustainable. One of those things has to give. And if you see this dollar like here, well, guess what? Defensives are going to get back in vogue here. So this is something to call out. Again, this is why I say, hey, when you have this bearish trifecta, dollar bullish VAMS, high yield OAS bullish VAMS, VIX ratio bearish VAMS, and more importantly, out of its channel trend, that's telling you that, hey, this might be a head fake. You might want to get more defensive again. Again, I think it's too early to make that call at this current juncture. But again, as I mentioned with the portfolio construction, we did want to, at the bare minimum, start marching towards having to make that call with respect to allocating more to a potential stagflation outcome relative to a more reflation or Goldilocks outcome. So that's, we'll do more of that. We'll raise more cash if we see that bearish trifecta. But until then, we're just going to kind of gradually, march towards heading for the exit. To the extent that we have to. On slide 77, looking ultimately the dollar will determine whether commodities can break out and broadly break out. I mean, like every commodity, like, right now it's like nat gas, it looks like Bitcoin did in 2017, and uranium looks like Ethereum did last year. I want every commodity. If the dollar, if this is a head fake in the dollar and the dollar goes back down as a function of everything I talked about with respect to the very dovish outlook from U.S. monetary policy, irrespective of all the dynamics that we're talking about in the labor market and the commodities market, the Fed can't do anything to ameliorate supply chain dynamics. They can take rates to 200 basis points on the Fed funds rate tomorrow, and it's not going to ameliorate one supply chain dynamic. So I think they're aware of that. And so if that does start to filter into currency policy on a forward basis, right now, maybe the dollar is reacting to this debt ceiling issue. And if on the other side of the debt ceiling issue, you could see a peak in the dollar, potentially head back down. That's when this thing can really start to make new highs and become an issue later in Q4 or maybe early part of next year. Again, we don't want to guess. We're just going to follow, count the data and watch the balls bounce. Look at our Chinese inflation view. So look at where Chinese inflation is on a secular basis. Like, it's pretty low. Like, these guys can reflate if they wanted to, and they're choosing not to. They're choosing not to. Obviously, I think they understand that inflation is heading higher over the intermediate term, but it's probably in the context of a deleveraging cycle. It's not going back up to here. We're not going to see this. We're not going to see this. We're not going to see this. We're dang sure not going to see this. So, to me, I think this is it's just reminding you of the resolve of Chinese policymakers not to reflate at the current juncture. All right, skipping ahead to Europe on slide 81 here. Looking at our Eurozone grid outlook. So growth momentum is positive through Q1. You got upside surprises in inflation will perpetuate a trending negative rock inflection in growth. Again, you see this is the modal outcome. When you look at this top row, it's the modal outcome. It doesn't necessarily mean that something like stagflation, what you see here, 28% chance, 48%, 45% chance, 30% chance. Like, we are in the thick of it with respect to the probability of stagflation being realized in economic terms for most economies in the world over the next few months. That's why stagflation has become the #1 news story in financial markets. That's why inflation, which is stagflation, whatever you want to call it, is the dominant market regime and has been, generally speaking, the dominant market regime since the beginning of July. The market is not stupid. As dumb as that slide 9 looks in terms of the jumbled mess that you're seeing here on that side of the chart, it's for a reason. The market is telling you that, hey, these outcomes are not as dispersed, they're not as wide, or they're not as narrow. It's not narrowly focused on one outcome like it was for, really basically 18 months. On slide 82, so Eurozone growth, we're kind of getting into the part of the curve where the growth, trajectory is starting to flatten out. You do have a little bit of upside into the early part of next year. Certainly from a base effect perspective, Europe did slow in Q4 of last year and into the early part of Q1 of this year. But the reality is, if the stagflation thing or deal becomes a real issue, it's going to be a problem. Like, Europe has a lot of positive growth momentum. This is our growth nowcast in Europe. You're seeing it looks very different. The hue, the coloring looks very different than the U.S. growth nowcast. U.S. growth nowcast has been, just decelerating and trying to mark a bottom before we bounce on the other side of Delta. Well, Europe has shown some pretty solid momentum throughout Delta, and it's telling you that, look, this is an economy that has scope and legs to continue recovering, which we expect. But again, this energy crisis is a real thing. It's very quickly overtaking COVID-19 as like the biggest threat to Europe's growth outlook. This red line is the city inflation surprise index for the Eurozone. That's hitting a new high. This is the blue line is the city economic surprise index for the Eurozone is making a new cyclical low. So that's about a stagflation clean cut stagflation signals you're going to get. You look at this right here as comparative base effects, or sorry, we're looking at European energy inflation, Eurozone energy inflation harmonized, and this is comparative base effects. They imply incremental pain on the inflation front in Q4 on the energy side, right? So this is again annualized month-on-month changes, and you look at it, really throughout Q4 of last year, there was hardly any annualized month-on-month change. So all we need to do is stay, all we need to do is create blue bars here. You're going to see the year-over-year rate of change really spike, and that's something you have to keep in mind with respect to some of these dynamics. On slide 86, Putin kind of answered this question for me just before we started recording today, but where will the incremental barrels of oil equivalent come from? Right, like this is U.S. rig count data. The blue line here, it's up, but it's obviously still way off its former peak. This is U.S. inventory data, making new lows here in terms of crude inventories. Like the world is strapped for oil. China's out there saying, hey, go buy it at any price. Obviously, Europe is desperate and really needs Big Daddy Putin to come to the rescue here. We'll see if that rescue is a legitimate rescue that can, prevent a real energy crisis from developing, or if it's just Putin being Putin and kind of trolling the whole world and yanking them like a yo-yo. We'll see. But this we know. On slide 87, showing our European inflation views. We've always had European inflation peaking later in Q4. It was on a different inflation cycle than the U.S., and that's something we think is being reflected here. You're seeing a little bit of forecast error with respect to the magnitude of the acceleration, and maybe you can actually see even a little bit more if the inflation crisis gets out of hand. But eventually, the base effects will tell you that once you get, kind of the latter part of Q4 and early part of Q1, we're going to start to peak and decelerate. So even inflation in Europe, where we're at the epicenter of this sort of energy crisis, is still transitory in rate of change terms. But again, in levels terms, we might have a problem in the latter part of next year once we get towards the bottom of these deceleration paths. On slide 88, just our Eurozone inflation model. As you can see, we're still firming with respect to some of the signals there. On slide 90, kind of getting into our portfolio construction guidance, and I'll be quick with this, because you guys can sort of look at that on your own time. The bull case for asset markets here is that U.S. and global growth bounce post-Delta, post the peak impacted Delta, and you have what our models have been projecting, which is flat to down inflation in Q4, particularly for the U.S. economy specifically. That's the bull case. That's Goldilocks. So we got G here. We got a 1 sigma delta growth acceleration to the upside. We have a 0 sigma delta deceleration projected to the downside on inflation. So loading that into the back test. Balance sheet still very much easing. Fiscal policy going to be tightening for a while. No matter what we get in the budget resolution, it's going to be a lot less than what we saw in fiscal 21 and 22. Then you have your fiscal 20 and 21. Fiscal 22 will be less than those two fiscal years. And then so the best positive thing you could say is, okay, Europe somehow survives this energy crisis and stays in a reflation event. The U.S. is in something that looks like Goldilocks from an economic perspective. And then you blend that all in and shake it all around and turn yourself around. That's the hokey pokey in risk management terms. Or the bear case, which is something a lot less like the hokey pokey and much more like the bankhead bounce, which went out of style and really hasn't recovered. That's the supply chain disruptions are a real thing. This energy crisis could potentially be a real thing, although I think it's still a little bit early to tell on that, and particularly if we get some incremental supply out of Russia, out of OPEC plus and things. We'll see. I think it's let's not jump the gun there. Again, I tweeted this morning or yesterday, like Deezus and Merrill, these guys who goes to Showtime kind of talk show and a funny podcast. They're tweeting up their podcast is about supply chain disruptions. Same thing with Bloomberg surveillance. Like when Deezus and Merrill figure out that supply chain disruptions are an issue, it probably means we're at or near the peak of supply chain disruption. So let's not overreact to that and be aware of a lot of these risks probably having already been priced in. But anyway, the bear case is supply chain disruptions. They feed into festering cost push inflation and causing consumers and businesses to retrench. And that's how you get stagflation, or as we like to call it here, just so we can say grid as opposed to GRSD, because GRSD sounds like a disease or something. Anyway, that's how you get inflation. And so you're talking about a 0 sigma delta lower on growth, a 1 sigma delta higher on inflation. Same thing with balance sheet and policy rate. But then you got the whole world at stagflation, and that tells you, there's a much different outcome in terms of the blended annualized expected returns, the covariance, the volatility, all that good stuff that we like to backtest, percent positive ratios as well. And so what we're doing here in these next series of slides is showing you kind of like what the expected return path for different sectors within equities, different style factors within equities, different countries, different segments and sectors within fixed income, and different currencies might look in one of those two regimes. Because again, I think it's still too early to tell to say it's going to be this or it's going to be that. Heck, it could actually be both. What if we have a debt ceiling catastrophe and we get this for like a month, and then it follows up by this because of all the things I said about the Fed and net liquidity are still legitimate things. By the way, you're going to get a positioning rinse out if that occurs. Maybe it's both. Maybe it's this for a couple of weeks and then we have this, or maybe it's the energy crisis just keeps us here. Nobody knows the answer to those questions. Not me, not anybody. I think we're at a very vulnerable state in markets where it's increasingly look like this scenario A is ceding probability points to scenario B. I don't know that scenario B is more probable than scenario A, but we certainly know the direction of travel with respect to the probability, so we need to be aware of that. And so we kind of have that same scenario analysis on 93 with global equities, 94 with fixed income, 95 with foreign exchange, 96 with global macro. And as we like to do, we renserize that sample and trying to get you into the things that we think on a long-only basis would help you, kind of outperform, with a lot of risk with respect to the portfolio construction. And that's how we want to conclude the presentation. As I mentioned, selling SPY, selling ag, making some room in the portfolio construction, the grid zero portfolio construction that's worked so well for a lot of you in recent weeks, making room for BNO and UGA, that's Brent crude oil and gasoline. We definitely want to be aware that the risk for this particular outcome has definitely gone up. And certainly the more that continues to rise, the more likely it is that we're going to have to sell some things in here and raise more cash. So you might see some signals from me that rest of the week. You might see some signals from me on that on Saturday or the next couple of Saturdays. I don't know. But I certainly do know that the risks are rising, that we may have to move and pivot to something that's a little bit more risk off than this is already positioned for. Obviously, when you talk about 20% deflation, 20% in inflation, 20% cash, you're pretty risk off to begin with. But I certainly believe that a lot of this stuff is just not going to work if we do go into a more deleterious market regime. So with that, Darius Dell, I know I threw a lot of you guys out there. Tweet at me, send me an email. We'll be back with you guys next time. It's our October macro scouting report. Hope you enjoyed the presentation. Cheers.